Hello, welcome to the latest in our series on the global economy. Today, the U.S. and the global economy. I'm James McCormack, head of the Sovereign team, and I'm joined today by Charles Seville, co-head of the Americas Ratings, and Brian Coulton, Fitch's chief economist. Gentlemen, thank you for joining us. Brian, we'll start with you as usual. Bring us up to speed on the macro story and the macro picture in the U.S.
Well, the US economy is kind of firing on all cylinders at the moment. We've got the consumer looking strong, bounced back very aggressively from weakness in Q1. We have business investment looking like it's still got quite a lot of momentum. Some of the indicators coming off a little bit, but essentially still signaling further strength to come. In the second quarter, we had very strong exports as well. I don't think that's going to last, but a pretty decent growth picture. I mean, we had 4.2% annualized growth in Q2. We don't think that's going to be sustained. It'll probably come down to an annualized rate of 3% per quarter in the second half of the year, but we're still going to be on track for something like 3%, not far off 3% growth in 2018 in the US.
Where's that relative to potential growth in the US?
Well, potential growth, when we looked at this very closely about a year or so ago, we were coming out with a number about 1.7, 1.8% per year. I think it's fair to give some credit for the tax package. I mean, it was a very substantial supply side reform, a very big reduction in the marginal tax rate for corporates. So I think there will be some supply side benefits from that. But in terms of the range of estimates that are out there, in terms of the benefits of the tax package, I think we sit at the lower end, maybe a 0.1, possibly a 0.2% per annum boost to supply side potential, but still only leaving us around 2%. We're certainly not of the view, which seems to be embedded in some of the government's own official figuring, that the US can grow at 3% on a sustained basis. That's definitely faster than we think supply side potential growth is.
Okay, and we'll pick up on the fiscal issues with Charles. How are we thinking about fiscal policy in general in the U.S., and how far is the U.S. from AAA public finances?
Yeah, well, we were talking about the strong economy, but you wouldn't know that from looking at the fiscal numbers. In fact, individual income taxes are doing very well, but corporate taxes have dropped pretty sharply as a result of the reform. And I think we're also concerned, about the long-term future of the public finances in the U.S. It is the sort of weakness in the rating profile, if you like. At the moment, general government debt is around 100% of GDP, and we see it creeping up. Depends how far out you look, but if you take a sort of 10-year view, you assume that interest payments rise, that mandatory spending rises, and that the primary deficit deteriorates, then you do get to some substantial rises towards the end of the period. And also, if you assume that some of the provisions in the Tax Cuts and Jobs Act, which currently phase out at the end of the 10-year period, if they stay, or if they stay, then we'll see sort of higher baseline debt than the CBO, for example.
Okay, and if we take a shorter time frame, kind of factor in midterm elections, are there any fiscal policy implications, you think, from the midterm elections?
I think the biggest one would be if we were surprised and the Republicans held onto the House, because they have talked about extending the tax cuts. And that would have impact sort of in the latter half of the 10-year window. I think if the Democrats take the House, which seems the most likely, but don't take the Senate, then I think you're in a typical sort of post-midterm scenario where the government gets fewer, the administration can get fewer things done. That's typically what happens after sort of a shift in control. As to the attitude of the Democrats on fiscal questions, I think there's a range of views, just like there is in Republican circles, but they're clearly not going to go for tax cuts. They wouldn't back that.
And Brian mentioned this very strong growth backdrop, weak public finances. So when you think about, at least in the short term, you mentioned longer term fiscal pressures, but in the short term, debt dynamics still look reasonably favorable in the U.S. despite this higher fiscal deficit?
Yes, I mean the debt is sort of debt to GDP ratios creeping up, but at a fairly slow rate just over the next couple of years, and it's not something that's going to trouble us in terms of a metric that we need to worry about.
Okay, and I guess one thing that could trouble us in terms of debt would be the debt limit, debt ceiling. When does that come back into
That
play?
kicks in again in March 2019. It's been suspended till then, and then of course you have that period where the Treasury can operate within the existing debt limits. We'd expect that to add a few months onto that sort of from March, and then that's when you get to the X date, which is when the Treasury really needs to get the debt limit raised in order to keep financing itself.
Okay. Brian, we've talked a little bit about fiscal policy, so let's talk about monetary policy and current views on the Fed. Where are we?
Well, I think in a way, the degree of easing of fiscal policy that we're seeing at a point where the economy is moving above trend, above potential, is actually cementing the Fed's determination to carry on raising interest rates. We expect them to hike in September and again in December, and then carry on hiking through 2019 with another three hikes. Jay Powell at his Jackson Hole speech did talk about the need for gradualism, which some commentary has been suggesting, maybe the Fed's getting close to the end. But I actually interpret that speech a slightly different way. What he was talking about there was the vast uncertainties which exist in the Fed's estimate of, say, the natural rate of unemployment and the natural rate of interest, and how it wouldn't be appropriate for the Fed to place too much weight on those sorts of estimates. But the reason he's saying that is if you do take the Fed's view of where the natural rate of unemployment is, which is above where the unemployment rate is now, and you do take the Fed's view of neutral, which is about a 3% in interest rate, it's quite hard, given that inflation is now at the Fed's target. It's come back after the dip in early 2017. It's now back at 2%. Whichever way you care to measure it. Unemployment's below the narrow. Then rates should be at or above neutral already. So I think really what the Jackson Hole speech was about was, look, we're not going to go straight there because we don't have enough faith in these estimates to make so we need to be a little bit careful and we need to go gradually. But nevertheless, if you listen to the way the Fed has been talking about the US economy, about the activity cycle, their last set of minutes, the word strong was everywhere. I mean, really, really bullish language, increasingly so. When Jay Powell stands up and talks about the economy, he said, everybody wants a job can get a job. This is a strong economy. Really, the only single area of possible weakness is the housing market. Housing starts have slowed down a little bit. Maybe there's some evidence there, tighter rates, but other than that, as I say, everything looks to be, have quite a lot of momentum short term, partly because of this fiscal boost, and the Fed is going to have to react to that and carry on normalizing rates.
So strong growth, supported by fiscal policy. Can we also use the word strong to describe the dollar? Do we expect the dollar to continue to strengthen from here?
The movements in the dollar in the last 18 months to us have really all been about where the surprises in global growth and global interest rate expectations have been. Now our baseline view is above the market's current expectation for how far the Fed's going to go. That in itself would suggest further strengthening the dollar, but I just think if you look at the balance of risks around our central case growth forecast, I think we're much more likely to see upside surprises in the US than we are elsewhere. The dynamics of global growth are changing, so global growth is still strong, but it's becoming a lot less synchronized. So there's clearer and clearer evidence that Eurozone growth has passed its peak. We're now seeing Chinese demand indicators come off in response to the earlier credit tightening there, whereas the US numbers, if anything, are getting better and better. US growth has got to be stronger in 18 than it was in 17, whereas both China and the Eurozone are going to see weaker growth in 18 than they saw in 17. So all the dynamics of growth to us point to further strength in the US dollar.
But the shape of the US yield curve would maybe lead you to a slightly different conclusion in terms of growth. So how do you think about the yield curve, possible inversion of the yield curve, and whether that means anything?
I mean, it's a good point, and a lot of people have been getting anxious about this because it's been one of the best lead indicators of US recessions, has been when the yield curve has inverted. And if long-term yields were to stay where they are today, the path of Fed tightening that we have factored in, would get you quite close to inversion within the next 18 months. But that's not our view. We actually think there's going to be some renewed upward pressure at the long end of the curve. We think bond yields are going to start to respond to the unwinding of central bank balance sheets, which have The QE has compressed the term premium. We think that's going to decompress as we go forward, including possibly some influence when the ECB stops purchasing assets in January 2019. So, first point is we don't see the yield curve inverting. That's not our expectation. Second point is a traditional interpretation of an inverted yield curve or a flatter yield curve is that it's telling you that monetary policy is tight in some sort of absolute sense, because traditionally an inverted yield curve means interest rates today are above where the market thinks they're going to be in the long term. So central banks is running a tight monetary policy to slow the economy down. I think that signal is much less reliable now because of the distortions to the long-term interest rate from QE. So it's much less of a pure kind of market signal than it has been in the past. So we're tending to discount those fears a little bit. That said, it's pretty clear the US is late cycle in terms of where it is in the economic cycle. We're growing above trend. Unemployment has now fallen to very low levels. We do see growth after this fiscal boost starts to fade. 2020 coming off quite sharply back towards potential. So to the extent that the flatter yield curve is telling you the US is late cycle, to that extent we do agree.
Okay, and the yield curve, when you think about it, Charles, any discernible impact on Treasury borrowing practices, say?
Well, I think when borrowing requirements rise, then the Treasury, is going to use Treasury bills and short-dated debt as the sort of the variable that they use to respond to that. It could be that as the deficit widens, they're going to issue more. But I think in terms of the sort of average maturity of their debt, they're looking to keep it pretty much stable. So it'll be a combination of short-term and longer-term issuance. Okay,
we'll switch gears a little bit and talk about trade policy, the other big issue, I suppose, in the U.S. and globally, but being driven really by the U.S. So what's your current read of U.S. trade policy objectives? How do you think it's going to pan out in the months ahead?
Well, I think there are sort of two fronts on the trade war, if you want to call it that. One is China, where I think the U.S. objectives are pretty ambitious and they're long-term, and they have a lot of leverage over China in terms of, the fact that they run a big trade deficit with China. And I think, we're going to see sort of continued action there. And then on Mexico, we've seen, a lot of pressure put on Mexico, and there has now been a sort of bilateral agreement, if you like, between the US and Mexico that essentially tells us that they've resolved their issues. Whereas with Canada, there are still some outstanding issues. Now, it's a question of procedurally whether the administration can get through and can get approved some kind of revised agreement.
And again, if we come back to those midterm elections that we were talking about earlier, any implications for a change in direction in trade policy as a result of the midterm elections?
It's very difficult to read. The Democrats, there are sort of anti-free trade voices on that side as well. So if they gain in the House, then it could be sort of negative. But essentially, a lot of in the short term, a lot of the power is with the president on this subject. So I think we'll have to see what he does.
Okay, Brian, I want to talk a little bit about the global economy and the impact that the U.S., both from a growth perspective and a policy perspective, is having on global growth. So is the U.S. supportive of global growth because the economy here is growing quickly, or is it not supportive of global growth because of this potentially strong dollar and higher interest rates? So how do you think about the balance of those two things, so the impulse from the U.S., if you will, globally?
Well, I think there's the strong U.S. growth, strong U.S. investment. I think clearly has positive spillovers on other countries. Canada, I think we've their industrial cycle, Mexico's industrial cycle is very closely linked to the U.S. So that there clearly are benefits there which go more broadly as well, but most profound in the rest of North America. I think where it's less supportive is, what's happening in the world economy is that demand is accelerating most in the economy with the least spare capacity to deliver on the supply side in terms of that extra demand, and that is creating tensions in terms of the direction of global monetary policy. And as we know, that's causing issues for the emerging market world. because the stronger dollar, high US Fed rates, increasingly high US short-term LIBOR rates because there's been an increase in the spread between LIBOR and the Fed funds rate as well. You can now get 2.3, 2.4 on 3-month US dollar deposits. That is quite a big change in global financial conditions, given the importance of dollar funding outside the US. There's been a big increase in dollar funding flows to emerging markets, and so by putting extra pressure on monetary adjustment, the strength of the US economy right now is leading to a tightening of financial conditions, particularly for emerging markets. So that's where I think there is a downside for the rest of the world from the strength of this US growth at this point in the US cycle.
I suppose the other obvious potential downside is U.S. trade policy. So this is a rather aggressive stance from the U.S. in terms of trade policy. So when you think about sort of plausible worst-case scenarios from a global growth perspective with respect to U.S. trade policy, what do you think about?
Well, the two big things that have worried us in the last few months have been the US focus on auto tariffs and the potential for a 20 to 25% tariff on all US car and car parts imports. That's a much bigger deal. There's 320 billion of US imports of autos in 2017. So just the scale of the shock involved would be much bigger if they were to do that. And then, of course, the US-China dispute, which is getting more and more intense, the additional 200 billion with a 25% tariff. Either of those two things happen, I think there's definitely a hit to global growth. So we did some scenario analysis in early July where we looked what happens if both of those things happen, and essentially if the US is imposing auto tariffs on Canada and Mexico, it's hard to see NAFTA surviving that scenario. So we threw in the tariff implications of a collapse in NAFTA as well, and then in that scenario we got a 0.5 point shock to world growth in 2019. World growth was 0.5% lower than the baseline in 2019.
I suppose the most affected countries would be China, Mexico.
Well, Canada, Mexico, definitely at the forefront. Interestingly, in that particular scenario, because the scenario was designed in such a way, the US is imposing car tariffs, extra tariffs on China, we assumed that the US trade partners, or particularly the EU, Canada and Mexico, would all retaliate back to the US on the car tariffs in the same way as they did with the steel and aluminium. So however much they export to the US in terms of cars, they will put an equivalent tariff on US exports to their countries. So the US is getting hit multiple times in this scenario because everybody's retaliating to the initial US measures. So the US was actually hit a little bit harder than China in this scenario, even though obviously it's a much more open economy.
Okay.
China shock was about 0.3% off their growth rate.
Okay, and we'll circle back and finish with the U.S. rating. It's a AAA rating. We confirmed it not long ago. Charles, talk to us about some of the issues that we think about from a rating perspective in the U.S.
Well, if you look at how the US comes out of our sovereign rating model, it scores as a pretty strong AAA. It has obviously structural strengths, its size being one of them, governance and so on. I think the obvious weak spot is the public finances, and that's largely because of the debt burden, but also now the fiscal stance sort of rather adds to that. But I think the biggest support really is reserve currency status, which is strong for most AAAs, but in the US case, I mean the US is the predominant reserve currency, and what that really confers on the US is what we call financing flexibility, in that the US can borrow. It has a very deep local capital market, and it can also draw on the global pool of savings. And it's interestingly been quite robust to the vagaries of current account surpluses in other parts of the world. There was a time when the emerging world was running large current account surpluses and recycling those into the US. The US can still borrow despite the fact that has waned somewhat, and that it's not relying actually as much now on foreign savings as it was, running a lower current account deficit than it has done at some points in the cycle.
And is there anything you think could get in the way of this role of the dollar, sort of medium-term issues? Do you think public finances could diminish the role of the dollar as a reserve currency in any scenarios, or do we think that the role of the dollar for the foreseeable future is exactly what it is today?
I think it depends actually what happens in the chief potential rivals to the US dollar, that is, sort of Frankfurt and Beijing, if you like. I mean, whether the euro, becomes a more, viable project, and equally whether, China loosens capital controls and it becomes more of a sort of potential haven for foreign savings. But we can see that there are certainly areas in which the yuan is taking, and Beijing is launching projects that will allow investors to use the yuan, and then it becomes more internationalized.
Okay, Charles, thank you very much. Brian, thank you. And thank you for watching.